Friends, are you aware that the IRS is aware about your Indian accounts? Indian banks, mutual funds, and others have already reported details of your accounts to the IRS. Does it mean that a catastrophe awaits you at the corner?
In my opinion, this is not a warning bell because the IRS has come out with a very lenient, streamlined procedure option whereby US taxpayers can now declare their overseas income and financial assets which they have not declared to the US IRS.
I am Rajesh Dhruva,
A chartered accountant and NRI consultant in India, and also the founder and chief executive of FrameOnline.com. But before we go into the details of streamlined procedures, it will be worthwhile to look into the requirements of US tax laws pertaining to overseas, that is Indian assets and Indian income. The US laws are very simple. Every US citizen, green card holder and H1 visa holder is required to declare his worldwide income and pay tax thereon. Additionally, there are quite few reporting requirements. If the financial assets outside USA exceed $10,000, then each spouse is independently required to report the assets in Form FinCEN 114 under the law of foreign bank account reporting. Then if the financial assets combined exceed $100,000 end of the year or $150,000 during the year, the same are required to be reported in Form 8938, which goes with Form 1040 under the law of Foreign Asset Tax Compliance Act. And then there are regulations regarding overseas investments in partnership firms, private limited companies, trust, as also gifts and inheritance received from abroad. Unfortunately, these are reporting requirements only, but failure to do so attracts penalty of $10,000 per year. And of course, investments in mutual funds abroad, that's in India, also have a very unique system of taxing. These are not treated as capital assets, and the gains are treated as normal income, and a notional gain arising by deducting the purchase price from the year-end value has to be taxed at normal tax rates. Unfortunately, large number of people, out of ignorance or negligence, were not paying tax on their global income. And probably the IRS knew about it, but they were not going into fishing inquiries. It was in 2014 that the US government entered into intergovernmental agreements with 130 countries, including India, whereby each of these countries, take the example of India, Indian banks, mutual funds, insurance companies, and depositories are required to examine their records and report the accounts of US persons being recognized through their citizenship, address, phone number, or place of birth. Report each of these accounts to the IRS. So now practically almost all the banks in India like State Bank of India, mutual funds like Birla Sun Life, almost every financial institution which is registered with the IRS, whose global identification number can be viewed on IRS website, have already reported the accounts of US persons as on 30th June 2014 if the balance in such accounts exceeded an amount of $50,000. This would have created severe difficulties for people who had not declared their overseas income and assets, because the US government since 2009 had already in operation voluntary disclosure schemes which required payment of penalty of 25% or 27.5% of the financial assets back home, and also required revision of tax returns for previous 8 years. But at the same time, the US government opened their arms for the taxpayers, and recognizing their follies by ignorance or negligence, offered the schemes of streamlined procedures, which were very simple and liberal. The streamlined procedures are very simple. Taxpayers are required to revise their tax returns for 3 years, pay tax on the global income which they have not declared earlier together with interest, file Form FinCEN 114 for previous 6 years, and other returns like 8938, 5471, 8865 and so on for 3 years. Additionally, they are required to pay a penalty of a mere 5% of the maximum value of financial assets held as on the 31st December of last 6 years. So if somebody has filed his tax returns for 2016 is required to revise tax returns for 2014, 15 and 16, file FBAR returns for 11 to 16, and pay a 5% penalty on the maximum balance held during last 6 year ends, as on the 31st December 2011, 12, 13, 14, 15 or 16. Whichever year one had the maximum financial balance is required to pay a mere 5% penalty. These documents, together with a declaration of non-willful conduct, meaning thereby the taxpayer declaring his failure to declare overseas income and financial assets out of ignorance and negligence, will literally buy absolute peace of mind for the taxpayer, because he gets an absolute immunity from all penalties whatsoever, as also civil and criminal procedure. We at FEMAonline.com are a group of chartered accountants and company secretaries, and we help NRIs in USA to prepare the entire docket required to be submitted under streamlined procedures. You can read more details on our website, FEMAonline.com. In case you have any questions, you can write to us, and if need be, you can also speak to us. Before I end, I sincerely urge each one of you to take this issue very seriously. Speak to your CPAs, speak to your tax attorneys, go through the web, and if you are convinced that this is indeed a very liberal but the very last opportunity, head for your streamlined procedure option. For sure, this is not a warning bell, but it is indeed the last wake-up call. My best wishes to you all, and I thank you for your time and attention. Thank you.